Hello everyone, and I hope you are ready for an exciting topic today. Today, we are diving into the world of digital assets like Bitcoin and other cryptocurrencies.
Hit Bitcoin and other cryptocurrencies.
Hello, Bitcoiners. Thank you very much. It's good to be with you.
The crypto exchange facilitated one of the most prolific money laundering operations in history.
This is a hot issue in financial reporting these days because these assets are new and IFRS has not fully caught up with them. Companies are getting involved with cryptocurrencies, and as an accountant, we need to figure out how to account for them properly in the financial statements. It might sound technical, but I will break it down in simpler terms so it makes perfect sense to you guys. Imagine a company decides to invest in Bitcoin or another crypto. Maybe they wanted to hold it as an investment, or maybe they plan to use it for transaction as a medium of exchange. Cryptocurrencies have become popular. Their values shoot up and down, and everyone is talking about them. But how do we show these in our books of accounts? If we get it wrong, we could be misstating assets or profits, and that's a big deal for investors looking at our financial reports. So it matters because digital assets can be valuable, sometimes worth millions of dollars, and at the same time very volatile. We need to account for them in a way that's true and fair and useful to the people reading the financial statements. Now, here is the challenge. There is no specific IFRS standard for cryptocurrencies or digital tokens yet. The standard setters have not issued a dedicated crypto standard. Perhaps one day they will, but who knows? So what do we do in the meantime? IAS 8, that is accounting policies, gives us a game plan. If there is no specific standard, we refer to the existing standards and the conceptual framework to find the best fit. In simple words, we have to use our judgments and apply the closest applicable rules we have. Essentially, we will be detective accountants, checking which existing standard could cover these digital assets. So before I get into the accounting treatment, let's clarify what digital assets are in this context. First, let's talk about cryptocurrency. This is basically a form of digital money. It's an intangible digital token recorded on a distributed ledger. Fancy term for a network technology called blockchain. No government or no central bank issues it or backs it. For example, Bitcoin, Ethereum, these are cryptocurrencies. You can use them to buy some goods or services from those who accept them, and you can trade them on the crypto exchanges. But unlike US dollars or euros, they are not widely accepted as legal tender, and they are not stable in value as well. One day, Bitcoin price is sky high, and the next day it could crash. So there is a lot of volatility. Alright, now let's talk about the digital tokens. My friends, all digital tokens are not meant to act like currency. Some tokens represent other rights or assets. For instance, a security token might give you the ownership in an asset or a share of a company's profit. It's like kind of a digital share or bond. Companies might create tokens to raise funds, and we will talk about that in a bit. These tokens also live on blockchains. Essentially, tokens can be designed for different purposes. Some are like currency, that is medium of exchange. Other might be like a ticket to use a service or a token that represents a stake in a business. Alright, so digital assets are out there and companies might hold them. Now, how do we classify and account for them under current IFRS rules? Let's think about it together. Step by step, using simple logic and IFRS principles. My friends, when you first hear about Bitcoin or crypto, you might think, hey, it's like a kind of cash, right? It's digital money. But hold on. IFRS has a strict definition for cash and cash equivalents, and crypto does not quite fit. Listen to me. Under IS 7 and IS 32, cash means currency. That's legal tender. Basically, the money issued by the governments like dollars, pounds, euros that you can readily use to buy things anywhere in that jurisdiction. Now, the question is Bitcoin legal tender? Not generally, at least not in most countries aside from some exceptions. You cannot take Bitcoin to the tax office or the grocery stores in most places and have them legally required to accept it. It's not widely accepted as a medium of exchange in the economy. So IFRS says it's not cash. Alright, what about cash equivalents? Cash equivalents are short-term, highly liquid investments that are easily convertible to a known amount of cash and subject to insignificant risk of changes in value. Does that sound like crypto? No way. Cryptos are highly volatile. Their value can swing 10% in a day, even an hour. And that's definitely not insignificant risk of changes in value. So we cannot classify cryptocurrencies as cash or cash equivalent in the balance sheet, as they fail the definition badly. They are neither legal tender nor stable in value. Okay, so if not cash or cash equivalent, then our next thought can be, should we treat it like a financial instrument, like an investment we mark to market? For example, maybe we say, I will treat Bitcoin like an investment in shares or bonds and use IFRS 9 financial instruments to fair value it through profit and loss. Unfortunately, that does not work either. Why? Because IS 32's definition of financial asset is not met. Look, financial asset can be cash, and we already concluded that crypto is not cash. Then financial asset can be a contractual right to receive cash or another financial asset from someone. Now, when you hold a Bitcoin, do you have a contract that says someone must pay you cash or something? Not at all. Its value might go up or go down, but there is no contract promising you anything. It's just like a token on a blockchain, not a contract with the counterparty. Also, financial asset can be an equity instrument of another entity. In this case, holding crypto does not mean you own a part of a company or have shares in someone else's business. So cryptocurrency does not fit any of those categories. It's not cash, not a receivable or bond, and not equity in a company. In short, it's not a financial asset. Therefore, we cannot simply apply IFRS 9 and treat it like normal investments in stocks or bonds. The key point is, there is no contractual claim inherent in holding a Bitcoin. Its value is based solely on supply and demand, not on a right to receive cash from someone else. Now, if crypto is not cash, it is not a financial asset, then what is it? Let's look at another angle. Does it have a physical substance? No, it's digital. You cannot hold a Bitcoin in your hands like a gold bar or a packet of coffee. So it's not an tangible asset. Now, having no physical substance actually points us toward intangible assets. Remember, IS 38 defines intangible assets as identifiable, non-monetary assets without physical substance. If we look closely, cryptocurrency seems to check these boxes. It's identifiable, each unit is separable, and you can sell or transfer it individually. Bitcoin can be sold one by one or in portions. It is separable from the entity. It's non-monetary. Holding a Bitcoin does not give you a right to a fixed amount of currency. Its value is not fixed in terms of dollars. It can vary. So it is considered non-monetary. IS 21 defines non-monetary asset as something that does not have a right to a fixed amount of currency units. Crypto fits that because there is no promise that you will receive X amount of dollars back. And then it has no physical substance. It's all digital. Nothing you can physically touch or see except on your computer screen. So it's look like that cryptocurrency meets the definition of an intangible assets under IS 38. Most accounting experts and standard setters have agreed on this. In fact, the IFRS Interpretation Committee, that is IFRIC, which is like the referee that clarifies gray areas, looked at this in 2019 and concluded the same thing, that for accounting purposes, treat holding of cryptocurrency as intangible assets, unless you are holding them for sale in the ordinary course of business, in which case it might be inventory. Don't worry, we will get to that exception in a moment. So our best bet is to account for Bitcoins and similar digital coins as intangible assets. Alright, now let's talk about what that means in practice. If we treat cryptocurrency holdings as intangible assets, how do we account for them? For this, we need to recall IS 38 rules. Initially, intangibles are recognized and measured at cost. That means when our company buys some Bitcoins, we record it at the price we paid, plus any direct cost to acquire. And in case of current crypto, there's usually are not many acquisition costs aside from maybe transaction fees. For example, if we purchase 2 Bitcoins for $40,000 each, we would debit intangible assets, that is crypto, at $80,000 and credit cash and bank at $80,000. That's our initial entry. Very straightforward, just like buying any asset. For subsequent measurement, IS 38 gives a choice, a policy choice for intangibles. We can measure the intangible under cost model. That means we have to carry it at the cost of $80,000 in our example, minus any amortization and minus any impairment losses. Or we can measure the intangible under revaluation model. Under IS 38, only if there is an active market, you can revalue the intangible to the fair value and put the changes in revaluation reserves, a component of equity, through other comprehensive income. Let's think, which subsequent measurement model should we apply? Many popular cryptocurrencies have active markets. For example, Bitcoin has active trading on exchanges, so we can get a fair value easily. That means the revaluation model could be used for those cryptocurrencies. And note, cryptocurrencies typically have an indefinite useful life. There is no inherent expiration date or limit like a patent or software license might have. Therefore, we don't amortize indefinite life intangibles. But we do need to test them for impairment annually or more frequently if needed. Now, consider the nature of crypto. Its price moves a lot. If we use the cost model, the value on the balance sheet stays at cost of $80,000 in our example, unless we impaired it. If the market value skyrockets, we do nothing under the cost model, but we might have to disclose the fair value in the notes if it is significantly different, but the asset stays at cost. But if the value crashes and we think it won't recover, we would book an impairment loss to break it down to the recoverable amount. And if we use the revaluation model, we could update the carrying amount to its fair value at each reporting date. For instance, say by year end, those two bitcoins are now worth $50,000 each. That is $100,000 in total. We originally had them at $80,000 cost. Now under revaluation model, we would revalue the asset to $100,000 and record a gain of $20,000. But that gain does not go to the profit and loss. It would go to the other comprehensive income and sits in revaluation surplus in equity, unless it reverses a previous revaluation loss. But for the time being, let's keep it simple. So we debit intangible assets by $20,000 and credit revaluation surplus, that is equity, by the same $20,000. Now my friends, here is something important to note, and this is something the exam might expect you to discuss. Many companies hold crypto speculatively or for trading, hoping to benefit from price increases. If we are allowed to put gains in OCI via the revaluation model, it means those gains don't hit the profit and loss statement. Some might argue this does not reflect the performance very well for such type of investment. Normally, if you hold other assets for trading like stocks, you would mark them to fair value through profit and loss under IFRS 9. But we cannot use IFRS 9 here, and IAS 38's revaluation put it in other comprehensive income. So it's a bit of an accounting mismatch. However, these are the rules as they stand now. Treat the crypto as intangible and optionally revalue through other comprehensive income. So potentially, a company's profit won't show unrealized gains from crypto unless they are actually sold, and that gain would be realized in the profit and loss statement. Still, the cumulative OCI reserve could not be recycled to the profit and loss. It can only be transferred within equity. Now, if the exam or anyone asks, you can mention this as a limitation or as an interesting point. It shows that current standards are not perfectly tailored to crypto usage. Let me give you a simple scenario to illustrate this intangible asset treatment. Let's say tech companies buys one Bitcoin on 1st January for $30,000. By 31st December, the market value, the market price of that Bitcoin is $45,000. If tech company uses the cost model, then on 1st January, they recorded the intangible at $30,000 and credit cash at $30,000. And at 31st December, they do nothing to the carrying amount. It would be still at $30,000 because we don't revalue intangibles under the cost model. However, they might consider if an impairment is needed. But in this case, no impairment is needed because the actual value went up. That might include a note disclosure that fair value is $45,000 now, but the balance sheet still shows the asset at the cost of $30,000. Now, if the tech company uses the revaluation model, then on 1st January, same initial entry would be made at cost. But at 31st December, since there is an active market for Bitcoin, they revalue the intangible to $45,000. That means increasing the asset by $15,000. And the general entry would be that intangible assets would be debited by $15,000 and revaluation surplus, that is equity, would be credited by $15,000. This $15,000 gain would be reported in other comprehensive income, not the profit and loss statement. The balance sheet now shows crypto asset at $45,000 and an equity reserve of $15,000 for that revaluation. Techno's company's profit for the year did not include this $15,000 gain. It went straight to the equity. So my friends, do we understand the intangible asset approach? The key points is classify the crypto as intangible, record initially at cost, and subsequently either use the cost model or revaluation model. Also remember, no amortization because of indefinite life. But yes, there would be an annual impairment testing. Alright my friends, there is one more twist. Some companies might not just invest in crypto. Their business might be trading or brokering crypto. Think of a crypto exchange or a broker dealer who hold cryptocurrencies to sell it to the customer. For those situations, IFRS might allow a different classification, that is inventory. IS2 inventories usually covers things like goods held for sale in the normal course of business. Typically, inventories is stuff like cars for a car dealer or phones for an electronic store, etc. So here is the question. Could cryptocurrency be considered the inventory? And the answer is yes. If you are in the business of selling crypto to the customers, then those holdings are like your stock in trade. For example, if a company buys and sells Bitcoin frequently with the purpose of selling them in the near term for a profit, almost like a commodity broker or a dealer, then those Bitcoin holdings are similar to inventory for that business. IS2 would apply. Now normally, IS2 says carry inventory at the lower of cost and net realizable value. But there's a special exception in IS2 for commodity broker traders. They can measure the inventory at fair value less cost to sell, with changes recognized in profit and loss. The reason is, for those types of businesses, fair value reflects their operating performance better. Cryptocurrency traders often fall under this category, similar to commodity traders. So if our company is, say, Crypto Dealers Limited, and it's buying and selling crypto daily, we could choose to treat our crypto holdings as inventory of a broker trader. In that case, initial recognition would be at cost, like purchase of any inventory, but subsequent measurement would be at fair value less cost to sell through profit and loss, not other comprehensive income, in this case through profit and loss directly. So if the value goes up, we record gain in our income statement, and if the value goes down, we record a loss reflecting the trading performance. This inventory treatment is actually more in line with how an active trading company's profit work. It avoids the problem that we mentioned with the OCI case. However, it is only appropriate when the company's business model is to trade these assets regularly. If the company is just passively investing its surplus cash in Bitcoin, hoping it would appreciate in future, that sounds more like an investment, and in this case, we need to follow the intangible asset route. But if the company is more like a crypto trader or exchange, then inventory at fair value through profit and loss makes sense. Let's clarify with a quick example. Let's say crypto trade company holds 50 Ether, a type of crypto, as inventory for trading. They bought these for $2,000 each on average, so the total cost is $100,000, and at year end, the price is $2,500 each, so the total value is $125,000. As a commodity broker inventory, they would mark it to $125,000 value. They record the income of $25,000 in their profit for the year from this increase. Debit the inventory by $25,000 and credit the unrealized trading gain by $25,000. If in the next period the price falls, they would likewise record a loss in the profit and loss statement. And this way, their financial statement shows the up-to-date value of the crypto, and the gain and losses flow through the profit and loss, which is logical for a trading operation. Now, not every student or preparer realizes this inventory option. So keep it in mind. If the exam scenario indicates that the company is a broker or trader of crypto, consider IS2 fair value option. And for any other case, IS38 is relevant. Alright, let's talk about some consideration related to presentation and disclosures. Given the lack of dedicated standard and the type of judgment involved, disclosure is very important for the digital assets. We need to be transparent with the users of the financial statement about what policy we applied and what risk exists. Under IFRS 18, that is presentation of financial statement, and IS 8, that is accounting policies, estimates and error, if we have made judgment in developing an accounting policy for something new like cryptocurrency, we should disclose those judgments. For instance, a company holding cryptocurrency should disclose that it has treated the holdings as intangible assets or inventory as the case may be, and perhaps why that classification was chosen. Also, if the crypto is material, they might even show it as a separate line item on the balance sheet, not just aggregated under other intangible assets. Another relevant consideration is under IS 10, that is event after the reporting period. Because crypto prices are so volatile, a big swing in value after the period end, after the year end, could be an important non-adjusting event. For example, suppose at 31st December 2025, a company holds significant bitcoins valued at $500,000 on that date. And by February 2026, when the financial statements are being issued, that bitcoin's worth dropped to $300,000 due to a market crash. Now that's a material event. An investor wants to know. The company should disclose this fact in the notes to the financial statements. Hey, after the year end, the crypto value fell by 40%, which if it had occurred earlier, it would have affected our numbers in the financials. We have not adjusted the 2025 figures because it's a non-adjusting event, but be aware of this subsequent development. Similarly, if its value shoot up, they might also note that the idea is to inform users so they are not confused. And one more thing, even though crypto is not a financial instrument, but company can provide risk disclosure as per IFRS 7 financial instrument disclosures. Companies might voluntarily describe price risks, etc., but that goes beyond our scope a bit. The main thing is disclose the accounting policy and significant judgments and estimates. There is a lot of uncertainty and new territory here, so we owe the readers some explanation. In summary, accountants must be crystal clear in their financial statements about how they have treated the digital assets. The absence of specific guidance means different companies might do slightly different things. So most will use the intangible model as that what IFRIC recommended, but to maintain comparability and transparency, we have to explain our approach in the notes. Are we clear on that? Great. Alright my friends, I will talk about the initial coin offerings or security token offerings very briefly, and we will cover it fully in the next lecture. Sometimes companies issue their own digital tokens to raise money. This is known as initial coin offering, in short ICO, or security token offerings, in short STO. Think of it like an IPO, that is initial public offering. But instead of shares, the company gives out digital tokens to the investors, usually in exchange for money or cryptocurrency. Each token might give some right, like access to future services, or a share in profit, or just be a speculative asset. Accounting for the issuance of those tokens is another tricky area. Basically, the company gets cash, so they will debit the cash, and then it has to figure out what the credit is. Is it a liability owing something to the token holders in the future? Is it equity, like issuing shares? Or is it some form of revenue if the token represents a prepayment for a future services? The IFRS community suggests analyzing the token features. If the token gives a right to future goods and services from the company, it might be deferred revenue under IFRS 15. If it represents a share in profit or something, it might be equity or maybe financial liability if there is an obligation to pay cash. If the token does not oblige the company to do anything, a common scenario in some initial coin offerings where it's just a speculative coin, then perhaps it's none of the above, and we might treat it under IS 8 hierarchy as a unique case. Some argue it could even be seen as other liability or just equity if it's like a donation, and we will discuss this in detail next time. I just wanted to tease that because it's the flip side of our current discussion. Today, we talked about accounting for holding crypto as an asset. In the next lecture, we will talk about accounting for issuing crypto or tokens. Alright, my friend, to wrap up today's discussion on digital assets, cryptocurrencies like Bitcoin and similar tokens are considered intangible assets under IS 38 because they are identifiable, non-monetary, having no physical substance. It's not cash or financial instrument. There is currently no dedicated standard, so we use IS 38 and other existing guidance. We account for them initially at cost, and subsequently we either leave them at cost less impairment or revalue them to fair value if there is an active market. If the business is to trade crypto actively like a broker, those holdings can be treated as inventory. And in that case, we can mark to market through profit and loss, fair value less cost under IS2 exception. Because this area is evolving and involves judgment, we must provide clear disclosures about our accounting policy and alert the users to any significant market changes after the reporting date. Since there is no standard for cryptocurrency, we rely on the framework and similar standard. The IFRS Interpretation Committee, that is IFRIC, guidance aligned with the above approach. Intangible or inventory? Always think, what makes the most sense and what do the current rules allow? Accountants need to exercise judgment here, and exam questions will expect you to discuss these possibilities and justify the chosen treatment. Alright, my friends, I hope this was enlightening. Digital assets might sound complex, but see, it comes down to applying the concept we already know in a new situation. In the next lecture, we will build on this by looking at how companies raise money through initial coin offerings and how to account for those transactions from the issuer's perspective. That's the another adventure in the land of accounting for digital assets. But for the time being, keep revising this concept and feel free to ask questions if you have any confusion. Thank you and see you in the next time.